So what do we do? If you don't know, I have some slides at the front of this that'll talk about what we do. This is why we look at small caps, but what we do essentially is we offer independent research at Keystone. We've been doing it for just under 20 years now. We have thousands of clients now, individual investors just like you across the country who pay us to find the best, most profitable small cap companies in Canada. We do not do financings. We do not get paid by the companies that we recommend. So our sole loyalty is to our clients. And our sole goal every day when we wake up in the morning is to find the best companies for our clients. So we are truly independent. We got our start in the small cap area, and that's what we're going to talk about today. But we also do income and dividend related stocks, and we've moved our coverage into the US as well. Why we look at small caps? Well, they outperform over time, but some of the biggest and greatest investors of all time will tell you, and you can see here from Warren Buffett, who we would consider one of the greatest investors, if not the greatest investor of all time. If he could, essentially what this is telling you, he would invest in the type of companies that we present to our clients every day. He is just too large to invest in these companies. So at a small cap level, or as a small investor, you actually have an advantage over some larger investors out there. And we're going to talk about what that is. There's a lack of coverage in this sector because they can fly under the radar, small caps. We are often the first coverage on some of the stocks that we recommend. Compare this to many large cap companies out there which have hundreds to even thousands of analysts following them at any given time. And you can see immediately why there's a potential in the small cap sector to find some undervalued gems. Literally at Keystone, twice a year, we go through 3,500 companies, all 3,500 companies traded on the TSX and TSX Venture to find you some select little undervalued gems. We can buy before big institutions buy. Just like Buffett had stated, you have an advantage buying at the small cap level. It's one of the biggest advantages that you have. You have the opportunity this way to beat institutional investors who often have restrictions on the amount of securities they can own in one issuer. As a small cap investor, we can buy in early, watch the company's intrinsic value grow, and often we end up selling down the road to larger institutional investors. Some of the best investments that we've made are companies that are growing cash flow in the most boring businesses. I'll give you a great example of that. In 2008, we recommended a little company called Boyd Auto Body and Glass. The shares traded at $2.30. What does the business do? All they do is fix automobiles. So you couldn't really get more boring, but more essential than that. I checked today the quote on the stock. Again, we recommended it then at $2.30. Today it traded at $103. It also paid us over that time, over that 10-year period, over $3 in dividends. We have not just recommended that company once. We've recommended it 25 times to our clients at prices as the stock has done this over the past 10 years. So that is an example of a company that we could buy in early, and we bought before institutions buy, and now you are starting to see institutions buy into this company. Higher growth prospects. At a basic level, it is easier to double earnings from, say, $1 million to $2 million than it is to double earnings from, say, $2 billion to $4 billion. So that means you're typically getting better value for your investment dollar with the types of small caps that we are looking at. High insider ownership, and I'll talk about this in a second too. Companies run by people with plenty of skin in the game have extra incentive to watch the stock flourish over time. Some of our best recommendations have strong insider ownership. Now it's more likely in a small cap company to see management own, say, 25% of the business with a market cap of, say, 25 million than it is for a large cap company and a management team to own 25% of a $25 billion business. It's just the law of large numbers. Now, we would say that all great companies start out small. Many of the world's greatest innovations come from small entrepreneurial businesses. Facebook, for example, was started in a dorm room. Even Microsoft, Cisco, the Walmarts of the world, all were once small cap companies. If you buy these companies early, before the broader financial arena, when they are profitable and trade at low valuations, which is key, your returns can be explosive, but you have to wait and be patient over time. Now I'm going to look at the profile of what we look for in a great small cap. I'm going to go quickly through here. We look at a strong balance sheet. This is so boring, but so critical. You look for a good cash position or a net of debt, particularly in the small cap area of our research. We like to see cash-rich companies. In the income stock area or dividends, larger cap companies that we look at, a healthy level of debt is often encouraged on the balance sheet. But smaller companies, we often love companies with at least manageable debt. We want positive cash flow. Cash flow is the lifeblood of a company. It allows the company to expand organically or through non-dilutive acquisitions or pay off debt. Sustainable growth, we look for that in the businesses that we try to recommend to our clients. Be it reasonable or above average, sustainable growth in cash flow, earnings, and the business helps drive stock prices higher. If you see a company that continues to go up and down in terms of their cash flow or run sideways, I'll show you a stock that'll either do this or do this over time. There's no company that you're going to find out there that has a straight line of growth. That's why when I illustrate my chart of Boyd, this is what it does over time. That's a beautiful chart to us over time doing that. And what allows us to stay in a company like that, as it does one of these, often even the small caps that we recommend pay dividends, which is a great way to stick in that share price when there's a momentary downturn. Attractive valuations. We're fundamental analysts, so obviously we look for companies that have GARP, or growth at a reasonable price. You need to have growth, but you need to be trading at a reasonable valuation for us to look at you. Potential for dividend or dividend increases. The first company I'm going to talk about today, we believe over the next 6 to 9 months, there's a potential for them to implement a dividend. That can be a game changer for the amount of investors that will then start to look at an individual investment. I talked about this already, but we like management teams with significant stake in the game or share ownership position. They are at least aligned with you as an investor, so they're pulling on the same rope. Businesses that we can understand and therefore value. We love that. We like operations in safe jurisdictions. In the past, we've been burned looking at companies that were domiciled in China, for example. We wouldn't mind buying a business that was operating in North America and doing business in China, but if you're set up with a Sino joint venture, we don't like the accounting standards, for example, there, and we would not invest in that. Positive or industry outlook or niche outlook going forward, we like to see that. And a great track record, whether that be management's track record in the last business that they built or just their track record within that business. If they're guiding towards 10 cents in earnings next quarter, do they hit 10 or beat 10, hit 11 cents, for example, or do they continually overpromise and underdeliver? If they do that, we won't look at the business. Finally, I'm going to tie it up here by saying we look at focused diversification as a strategy for our clients in the small cap or growth area of their portfolio. 8 to 12 stocks. We believe that is the sweet spot to which you should buy. We don't want you buying 2 or 3, even if they're our most high conviction buys right now. That's too much company-specific risk. We don't want you buying 30 or 50 individual companies because you just became the market if you buy at that level. And we believe we're trying to beat the market. So to beat the market, you can't just be the market. And if you know, we often see portfolios of 50 to 100 individual stocks. If you're going to do that, you might as well buy a market ETF and call it a day because you've done the same thing. We select stocks from a variety of sectors. Our research, when we look at those 3,500 companies in Canada, invariably that'll lead us to different segments of the market, but it is good to diversify. You don't want 10 of your 10 stocks in the resource sector, for example. With this strategy, if we have one stock perform poorly, and anybody who tells you, who's an analyst, that every stock they recommend will go up, I would run out of the room right now if I was to say that. You will have losers. If 3 do average, 2 above average, 2 very well, and 2 excellent, if you could get one Boyd auto body in your portfolio, this is what brings up your results over time. And I think this is key. Don't buy all those 10 stocks at any one given period. Say you sign up to our service. I understand clients get very excited. They want to add those 10 stocks right away. If you build that portfolio over a 12-month period, for example, buying 1 or 2 stocks a month, it guarantees that you're not going to buy all your stocks at a given market high in the year, which is key. So the first company I'm going to look at today, Dynacor Gold Mines. Now, it's blasphemy for me to say this here, but we hate junior exploration companies. We call them destroyers, great destroyers of capital over time. This company is not an explorer, or it does not mine. It actually mills. So they're unique. They trade at about $1.80. They're operating in Peru. They have a government-approved ore processing operation, so they're more of a miller than a producer. They have a lot of small-scale, hundreds of small-scale miners that bring the ore to them as feedstock for their mill. They have a new mill they've just installed, and there's been some great news that's come out of that just in the last month, and we'll go over that in a second. These are the financials. These aren't as exciting as what we are projecting going forward, but in the last quarter, they had around 3 cents per share. That is US. They trade in Canadian dollars, so it's actually closer to around 4.5 cents that they actually made in that quarter. But 26 consecutive quarters of profits, which is very rare to any resource-based or commodity-based company. We like that. But it's the recent news that provides us with significant optimism. So on January 9th, they announced the final payments on their debt facility, so they are now debt-free and in a net cash position. We love businesses like that. The last 5 months, Dynacor has made an aggregate of $6.3 million in payments, that all out of cash flow, so they've retired all their debt. Just last week, January 18th, they announced that their Chala gold facility was running at 300 tons per day. That is capacity. They got to capacity on November 25th, and it continues to run there. What that produced was 8,908 ounces of gold in the last quarter, which is up 31% year over year in that quarter. That's tremendous growth. They had record quarterly gold production of just, in the range of 24,000 ounces. We believe that they are positioned to do around 100,000 ounces this year. They're closing in on that. You can see the way their production just over the last year has ramped up significantly. Despite this, the share price has actually gone down over that period. Production is ramped up. Sorry, here you see considerable ramp up in terms of production. That's what we like to see. Now, they upgraded, like I said, to 300 tons per day. They are going to do an upgrade on that at some point during this year. They can pay for that $1 million upgrade to get them up to 360 tons per day with cash flow. So there's no dilution coming, and that'll be a 20% expansion for the business. We like the evaluations. If you look, adjusted EBITDA, we're projecting this year of $18.5 million. That's Canadian, or 47 cents per share. Like I said, they're trading at $1.80. The cash flow, we would estimate at least 34 cents per share. Traditionally, historically, this company has traded between 10 and 12 times. If they just traded at 9 or 10 times, that would get the shares, which are trading right now $1.80 in that range, to the $3 range. Of course, all of that gets thrown out of the window if the price of gold goes in the toilet or something, and that's what we kind of hate about gold-related companies. But there is a good bet for a company in this industry. If we look at a fair valuation, like I said there, it has significant upside. That if it got to the $3 level, we'd be extremely happy with this recommendation. The other wild card here is the company has stated in the past in presentations when they paid off all their debt, when they got to 300 tons per day at their mill, both of those boxes have been checked off. they would likely look at paying a dividend. If they start paying a dividend, you get a different type of investor that starts looking at the stock, higher valuations potentially. That's something that could be a catalyst for the shares this year. Now, this is a backdoor way of playing a recovery in energy. This is a company that we recommended this originally about 15 years ago when it traded at 69 cents. Sold it 6-7 years ago when it traded at 12 bucks. Just recently recommended our clients buy in about the $7, $7.50 range. It's trading at $9.15 right now. What do? Well, they make transformers. Not Autobots and Decepticons. They make transformers that are used for power. So for the stepping up of power so it can travel over a long distance, and the stepping down of power so it can come into your home, for example. Now, how does this factor into the resource sector? Well, they sell large transformers to the mining industry. They have a great core business. They hadn't sold into the mining or energy industry. They sell it. They're available for sale, but because of the downturn in the last 3 years, they basically sold nothing. You've just in the last couple quarters seen them pick up business in that sector, so you could see a strong uptick. They're already, with their core business, busier than they have been in the last 10 years. You can see here revenues for the last quarter were up around 19%. Earnings, tremendous uptick in earnings. They made 14 cents per share in the last quarter, up from basically 1 cent in the same period last year. That's a tremendous growth rate in earnings. We think it's growth at a reasonable price, and I'll show you why. Adjusted EPS estimate for this year, that should come out in March, is 70 cents. So, its PE is about 13.1. The market average PE right now is probably 18, 19, depending on what you're using to calculate that. So it's trading at a discount to market, despite the fact it's growing above the market rate. We like businesses like that. Fair value estimate, we would see a 21% lift from where the shares are today. It also will pay you about a 3% dividend. So, it's roughly around 25% uptick. Again, we bought in at $7. We think that this is a conservative estimate of where the company could be over the next year. Growth. Next year, we think we could see growth in earnings up 15%, so that would get you 41% higher. Add the 3% dividend, you're starting to get near 45%. Again, that would be a tremendous return. Driving the growth is cost rationalizations. We've seen that, and better strength in solar and mining. This next company is what we came out with a report called an orphan report. These are stocks that are completely ignored by the market, and sometimes for good reason. Management of this company doesn't talk to the market, but it's a deep value situation. It trades at $1.50. We talked about it in our orphan report and recommended it when it was about $1.20 just 3 months ago. They're based in Perth, Australia. Wear-resistant fused super alloy. It's a patented technology they use. Very profitable over time, supporting the mining industry directly. 27% revenue growth last year. Net earnings were 21 cents per share compared to a loss last year. This company, why we call it a deep value, they have 12.9 million, 75 cents per share in cash. Like I said, they traded at $1.50. Half their market cap is in cash. They also have a $4 million asset that's held for sale. So it's almost 65% of their value held in cash. The risk on this company isn't for the faint of heart. We have to really stretch our coverage to look at a company like this, but the valuations at 7.14 times earnings. You don't see that hardly anywhere in the market right now. Cash out, if you take the cash out of the business, the PE is 3.5. When we recommended it originally, PE was under 3, so very low PE. It's a deep value situation. Fair value estimate, we think there is a scenario where this company would be bought out. We could see something of that potentially. 245, that range, about 63% higher than what it trades today. Geodrill, I'm just going to go through this quickly. Company trades at 205. Servicing the mining sector, drilling. They're actually in Africa. The speech before us, we're talking about Africa, I believe. They have a fleet of 58 rigs. Those rigs, 10 years ago, they had, I think, six rigs in that range. They drill for a number of names that you might know: Newmont, Kinross, Acacia, Endeavor, Newcrest, Sentiment, a number of companies, both large and small in the mining segment. Revenue growth wasn't exciting in the last quarter. Earnings came in, significant uptick in earnings, 6 cents per share, up from 4 cents in the same period last year. Again, those are in US dollars here. The share price trades in Canadian dollars, so it's actually not 6 cents, it's closer to 7.5 cents, so it offers good value, and we'll show you why. Valuations, 19 cents in trailing earnings, 10.78 times PE. Again, the market trades at anywhere from 18 to 20 PE, so it's below market PE. That's our estimate in terms of earnings this year. So it's again 9.7 times PE. Fair value estimate would be around 310, which is a significant bump up from where you are right now. Growth, uptick in commodities again. We think the pricing environment is getting better. They have been a bit of a price taker. We think that can be changed going forward. I'm not going to be able to get to this company, but this is a company that we are looking at. We bought 5 years ago at $2, sold last year at $6.25. It's trading around the $4 range now. One of the best balance sheets in the energy service sector in Canada right now. I think they have a flat first half of the year, but you might want to look at them in the summer if energy prices stay where they are right now. It pays a great dividend too as well. Thank you very much. I'll walk to the back if anybody's got a couple questions. And thank you. I'll be at the World Outlook if anybody wants to come by that. I'll be speaking there this year. It's a great crowd there. About 1,500 people go. I think there's a few tickets left. So we'll see you there. Thank you.